Thanks for joining us. Really excited to have with us Ben Claremon, research analyst at Cove Street Capital based in Los Angeles. Ben, welcome to the program.
Thanks for having me. Happy to be here.
And we're going to talk about how to assess management. What are some of the key aspects of that analysis that you think are important and perhaps underappreciated, misunderstood by some investors. Before we do that, tell us a bit about your path as an investor. How did you get interested in value investing?
Well, I wasn't one of those people who was investing in my personal account since I was 13. I came to value investing in a little bit more of a circuitous manner. I went to Wharton undergrad and I concentrated on commercial real estate, which is what my family's business is in. I spent 5 years in that business and I just didn't enjoy it. And in the midst of kind of looking for what the next step was, a buddy of mine gave me a copy of Ben Graham's book, The Intelligent Investor, and it may sound kind of cliche because it maybe is, but it changed my life. I read the book. I felt like there was something that spoke to me about value investing, spoke to me about the stock market, and I made the kind of crazy decision to try to leave my family's business and get a job on the buy side. And in the process of doing that, I've read as many value investing books as I possibly could. I think I'm very, very strongly influenced by Ben Graham. I think there's a certain philosophy and way of going about investing that really spoke to me. But I just like Buffett started with Graham and moved towards more of maybe a Phil Fisher kind of way of looking at the world. I think I'm starting to move that way as well as kind of understanding that there is a reason for investing in really good businesses. And so I guess a lot of people know me as the Inoculated Investor. It was a blog I created after the 2009 Berkshire meeting. Decided to take notes, and then the rest is kind of history. Fortunately, I have retired or kind of stepped away from note-taking. These days, I spend my time looking for cheap stocks, but I maintain a strong passion for value investing. In fact, I just got back from my 6th consecutive Omaha Berkshire meeting.
And tell us a bit about perhaps what you learned at the latest Berkshire meeting that really speaks to the topic here at hand about management and how to go about making judgments about management.
So it was an interesting time for the meeting because there was a lot of press about the Coke incident, let's call it, in which the Coke compensation practice was questioned by David Winters, who was a shareholder of Coke, and he brought Buffett kind of into the fray by sending him a letter. And not to get into the nuts and bolts of it, but the question was on the table about excessive compensation in management. And I think to some extent, not so much compensation, but management overall is a topic that a lot of value investors don't maybe pay enough attention to. You like the business, you like the valuation, and you just assume that management is incentivized and will create value for you, and that's not always the case. And there's a graveyard of value investors who have found that out the hard way. And so I think this topic with Coke and assessing management, assessing compensation. Is really pertinent, and I think a lot of value investors maybe don't spend enough time thinking about the people. I mean, I know investors who say, "Oh, we never meet management. We don't want to hear their pitch." But how do you size people up? I mean, if you come in with a certain amount of skepticism and understanding that they are, potentially professionally trained to give you a pitch, I mean, you have to understand that. You have to be skeptical, but you also have to size people up. And there's just certain things that certain questions you can't ask, on calls. There's just certain ways of assessing people and incentives and what drives people that's just not available, without meeting them. And so we at Cove Street, and this will go into our topic, I think, a little bit, we really focused on what drives people, what have they done in the past, and what can you extract from their past that tells you what their future is going to look like.
Now, let's perhaps step back a bit and kind of think about the investment process. So at which stage does management really enter your thinking? Give us a sense of the idea generation process, the filtering process, and then at which point do you think about management, and how much time do you then spend on that analysis in the process?
See, that's a really interesting question, because it's probably the most important thing, but you have to save it for last, because if you start with a proxy statement, you don't know what they do and you don't know what the stock is worth, and so you kind of have to start from valuation and quality of business. And so we screen for both good companies, which are kind of the typical Buffett compounder companies with really high returns on capital and long-term track records of success. And then we also screen for Graham stocks, which is more of a cigar butt or a net or something that's looks like it's trading well below intrinsic value, but maybe cyclical or may have other industry issues that we deal with. And so we screen for both of those. And so that's the first step. And it's usually valuation screens, either a NOPAT screen, EBITDA screen. We also have a number of behavioral screens, like spin-offs and things like that. Something that are structural things that are more kind of like qualitative than quantitative. And so our first step is always to dive into the business. What kind of business is this? Is it a good business that generates high returns on capital, or is it a low margin, high capital intensive business that is potentially cyclical and you want to buy it at the bottom, try to buy it at the bottom of the cycle. You don't want to pay up for it. And so we have an interesting portion of our process that I think maybe, we don't do anything completely unique at Coast Street, but I think is a little different from what other people do, is that in the process of assessing the business, we code the company. On a 1 to 4, with a 1 being a perfect Buffett stock like, Coca-Cola, and 4 being the most cyclical Graham stock that you can possibly imagine. And what that does, and there's 2s and 3s in between, depending on which side you're on. And what that does is it sets our sell discipline. And we basically preset our sell discipline based on the quality of the business. If it's a 1, if it gets near fair value, we're likely to hold on because it's going to compound at least at its return on equity potentially. If it's a 4, we're out. We're not going to fall in love with the cyclicality or the management story. We look at the business, we assess what it is, and we preset our sell discipline so that if something does hit our target price, we know what to do. So that's an interesting. I think that's a little interesting thing, and we'll get into the management in a second. So that's business, and then valuation. We try to triangulate value very simply. We use discounted cash flow. I know a lot of value investors don't, and they because they think there are a lot of assumptions that go into it. Absolutely, there's no question. But it's just one part of our valuation stool. We use some of the parts. We'll use historical multiples. We'll use DCF. We'll use Ben Graham's EPV analysis. And what we're trying to do is triangulate and say, if 3 or 4 of these valuation metrics based on relatively conservative assumptions are giving you a cheap stock, then there's a chance, and it's not always true, but there's a chance that the stock is undervalued. And so let's just say, for example, we get to a stock where we like the business and we like the value. The next step, I think, and we spend a lot of time on this, but the next step is a proxy statement. And I think the proxy statement, you just don't hear a lot of people talking about it. It's not something that's top of mind for all investors, and I think it's really one of the most important documents you can ever look at. And so what we do is we dig into it, and we want to see how are people compensated, and it's not just long-term versus short-term. I mean, I think we would prefer people to be long-term compensated based on rolling targets, but also what kind of targets? Is it earnings per share, which can be managed? Is it revenue, which can be boosted in expensive margins? Or is it something like free cash flow or operating margin? Things that are, people who are valuing the business are much more concerned about than maybe, earnings per share, because that's just one valuation metric. And so there are a number of things we look at. We look at the board structure. That's really important. We scrutinize each member of the board to see if they're adding value. And I think, when we're voting proxies, we're happy to vote against members. And if we're voting on Coke's proxy, it's not going to mean anything. But if we own a significant portion of the company, it can mean something. And so we really, really scrutinize management, and that's not just the CEO and the CFO. It's really, if it's a retail company, the chief marketing officer or chief merchandising officer can be really large components of the business. So we scrutinize that. Look at board members. So it's the last part of the process by necessity. But I would also argue that it's one of the most important, because you can have a great business and a great valuation, but a poor management team that is non-incentivized can destroy all of that. And so we just, it is, again, business, value, people. Those are the 3 legs of our stool, and the people part is really important.
what do you think is perhaps misunderstood or underappreciated when it comes to the proxy statement? So give us a sense of, is there one kind of process that you follow with each candidate for investment, or do the areas in the proxy statement change in terms of your focus depending on whatever situation it might be?
So just a little bit of an aside, we have an interesting process at Cove Street. Each year, someone is delegated to be the proxy person. And so this year, unfortunately for me, it is my year, but that means I read the proxies from all of our companies. And so my boss, Jeff Bronchick, our portfolio manager, really wants us to get a sense of the way different proxies are written, the way people are compensated, and so that once you've read 100 of them, you really know what to focus on. And so it's been arduous, for sure. But it's been really valuable in terms of looking at the different ways that companies approach compensation and board structure and stuff like that. So that's just a little aside. So I think I've become somewhat more experienced in assessing proxy. So I think I might be able to help, in terms of what I look for. I think the first thing that I look for, and it may be kind of obvious, but is literally how is someone compensated, right? If you have a breakdown of base salary, bonus, and long-term equity, how is that person compensated? And there are a million different things, and there are different mixes, but maybe I'll point to some things that I think everyone should be looking at. So start with the bonus. What are the targets? Not just what are they based on, but in terms of the numerical target, for example. So what we see a lot is that companies have a really small band, right? So if you achieve 80% of the target, you get your bonus. If you achieve 110% of the target, you get a slightly higher one, but there's a max. So basically, even if you did 200% of the target, you would only get so much, but then you're also capped on the downside. So what we see is that people are really almost compensated for being in a small band, as opposed to trying to exceed, because there's no incentive to. Plus, in some cases, they get their full bonus at 70% of target. It's really a small band that I think is really just not well structured. And so I think people should really look at, I think people just kind of read through and they maybe gloss over the numbers, but if you're seeing a company that has a really small band and they're basically guaranteed a specific bonus based on even mediocrity, and even if they do really well, they can't get a much bigger bonus, that's not what we're looking for. We're looking for people who are really driven in incentive to exceed these often very, very simple and easy to hit targets. And then, so also when thinking about the bonus, what are the metrics? Again, I think anybody who is compensated on earnings per share and revenue or market share, things like that, even total shareholder return, I have a little bit of a concern about that, because short-term stock movements over a year, that's not real. I'm not interested. If you're taking a 3 to 5 year time horizon, I don't want someone doing something just to boost the stock over a 1 year period so that he or she can get his or her bonus. So I think the things that we really like, anyone who's compensated based on any return on assets, return on equity, return on invested capital, any kind of measure of free cash flow, or a rolling maybe 3 year total shareholder return. So yeah, you get compensated over 3 years if your returns are well ahead of the comp group. That is something we're looking for. And so that's a bonus. And then in terms of long-term compensation, equity compensation, I think very simply, we want as much of it to be in performance-based as opposed to just time vesting, right? If you can just collect by being there, and whether you hit targets or not, that's not really an incentive. What the best ones we see are when they're 80 or 90% performance-based. If you don't reach certain targets that are preset years before, you're not going to get your equity. That is really an incentive, and it really makes people think about the way to reach those goals. And if their goals are aligned with us in terms of free cash flow, returns on invested capital, you can assume that that person is well incented. So I think the first thing, I guess, is compensation. Moving from there,
let me just maybe come in there, and before we move on to other aspects of the proxy statement, what would you say are perhaps some good role models, companies that have structured their compensation in a way that really is ideal? What are some of the, good examples that people should study and kind of model their incentives?
So if you want to see, there are basically two buckets that I see really good proxies in. One, people who are maybe value investors at heart and talk as much, and then two, people who have been pushed around by activists. So I'll take both of those. We own a company in our all-cap portfolio called Allegheny Corporation. It's an insurance company run by a gentleman by the name of Weston Hicks, who is kind of a value guy, and it's kind of a Buffett model of the insurance company, and underwriting profit and float and the investment portfolio. It's kind of the same thing, but they have a really interesting compensation where they are compensated, based on a rolling period, and they're based on they're compensated based on the return of the accretion of book value, and they have a bogey of 8% that they have to hit, 7 or 8% that they have to hit, right? And so, book value per share, growth target 7-8%. If they don't hit that, they don't get, they don't really get their bonus. That's a really interesting way to look at it. And the other one, on the other side, is someone who maybe didn't think that way beforehand, but once an activist got involved, Relational Advisors, a group out of San Diego, that does a really nice job. And we own a company called PMC Sierra in our small cap accounts that has been relationalized as it were, and you just look at the structure and you say to yourself, this is clearly someone who is focused on free cash flow, returns, not overspending, on R&D and capex, that kind of thing. So I think, there are very few companies, and because the truth of the matter is where do these things come from? People hire a compensation consultant, right? And more often than not, and this is my skepticism, the company tells the compensation consultant what they want to achieve, and the compensation consultant crafts something for it, and then I think there's a disconnect there, because what about what the people who own the shares really want to happen? And so there are very few companies who just intrinsically understand the way to compensate people, and I'm not. Maybe I'm being a little skeptical and overgeneralizing a little bit, but I read a lot of proxies, and for the most part, they're okay. I think the presence of activists and maybe a little bit more focus on compensation and structure has made people think a little more thoughtful about the way they're compensated. You see egregious compensation for sure, but I think I rarely see something say this is absolutely terrible. For example, and I'm not going to name the company, but there is a company whose management team was compensated on segment margins, but excluding G&A, right? So all G&A was excluded from their compensation, and they were only compensated based on the segment margins. And so there's absolutely no incentive whatsoever to control G&A. And that's an example of a horrific one. And if you ever see that, I think you really have to question the people in charge here, because they're absolutely not compensated correctly. There, as I was saying, there's just not a lot of people who intrinsically understand exactly the best way to compensate people. And so I think by reading the proxies of someone like Allegheny or PMC Sierra, coming at it from two different worlds, but in terms of industry and why they thought this way. But I think you can learn a lot. And I think those are two really good proxies that I've read recently.
Let's move on to perhaps some of the other aspects of the proxy that you think are really critical and that you would focus on.
So let's just talk really simply about the board. So the question you have to ask yourself, I think there are a couple questions. One, is this board likely to do things that are going to create value for shareholders and to facilitate the management team to do things that create shareholder value? And the second thing is are they structured and compensated correctly? Addressing the first, it's a lot of boards, I feel like, they want star power. They want the former CEO of this, or the former CFO of this, or the former, government official, or something like that. And you look at it and you look through it and you say, there's not a single person on this board who has any specific knowledge that's obvious of the industry that you're talking about. a lot of stars from, consumer packaging companies and from banks and all this stuff, but where's the person who really understands the industry? And so I think you want a mix in terms of structure. You want maybe some people from who have experience in the industry, some people who have experience in managing global companies, for example, someone with experience in dealing with government affairs, but you just want a mix. You don't, and I think you see companies trying, but I think there's just too much of this cachet of the star, right? And so I try not to look at a proxy and be like, oh, this guy worked for some company I never heard of. What does he or she matter? It's more like, well, what is this person's background? What are they experiencing, and does it have any relevance? So that's, we go through each board member, and you're just reading a bio, right? There's no real way to say, oh, this person doesn't belong on the board. But, I think the Buffett described it really well at the meeting. I think the most interesting question, and I guess he's stated this before, but it really crystallized it in my mind. So they asked him, why does your son, Howard Buffett, why did he not vote against the Koch proxy if you personally, Warren, thought it was egregious? And Buffett said, basically, and I'm paraphrasing because I didn't take notes this year, so I'm paraphrasing, but he said, half of a board's obligation is financial, and the other half of your obligation of being on a board is personal, relationships. And he's basically said that if you go in and you're the one who's raising hell and saying this is egregious, no one's going to invite you to play golf with them, and no one's going to invite you to their, to dinner, and you're likely to, if there's ever a chance to get you off the board, there's possibility that they're going to get you off the board. Now, I don't know what that says about corporate America. I would not say that's a positive thing, but it's realistic, and I'm certainly not defending Buffett in this case. I don't know what he should have done, but what I am saying is that the reality of the situation is that a lot of boards are social entities, and so there's no real way to know what people are going to do when they sit there, and Buffett said it. They look at the proposals probably an hour before the meeting. They come into the board meeting, and the CEO or whoever the lead person is says, "This is what we think should happen." And there are very few people who either have spent the time, one, because they either have full-time job of their own, or two, they're just not that. This is just a nice check for them. Very few people are going to raise their hand and say, "This is wrong." And so that's the structure of most boards. And so if that is the case, the question is, what can you trust them to do? In hindsight, it's so obvious. You could say, how could you have made this acquisition? Obviously it was messed up, and there are questions about their financials, and the management team was deemed aggressive, and the valuation was ridiculous. How could you have done that? And most board members are like, I don't know, the CFO said it was a good deal. And that's the reality. And so as value investors, that's something to think about, right? I mean, it doesn't mean that you should give boards a pass and say, oh, they're just a bunch of know-nothings, because I don't think that's true. But it is also not true that these group of 10 or 12 people, their main focus in life is figuring out how to make you money. And so there's a balance there. And so I think what you want to see is a certain number of things that are pointing in your direction, that are maybe helpful. And so one of them is board structure. We are 100% against staggered boards, right? There's no reason why every director should not be elected every year. I would say in politics that's a bad thing, but on boards it's probably a good thing. So you can get new blood if needed, if there's an activist involved, or if the proxy battle needs to be run. Give people a chance. And I'm sure there are a lot of companies that don't do it, but I've seen a lot of companies recently destaggering their boards. I think there's a lot of pressure from shareholders to say we're not aligned here. And the other thing that, aside from the board structure, or in addition to the board structure, I would say, is chairman and CEO. It's really hard, right? It depends on the person. I mean, but let's take J.P. Morgan, for example. We own J.P. Morgan in our all cap accounts, and Jamie Dimon, I would say, has done a pretty good job navigating the financial crisis, the post-crisis, making J.P. Morgan just a juggernaut in the industry. But I don't like the idea that he's chairman and CEO. I just think that those positions should be split. And I know not everyone shares that view, and this is absolutely nothing against Jamie Dimon personally, but it's just structurally, I think there needs to be a separation. You just want some independence. And I think on the topic of independence, you do look at it. So in the proxy, it'll say these 6 of the 12 are deemed independent and these 6 are not. And so we do look at that. I mean, I think what you don't want, especially in an acquisitive company or a company that's spending a lot of its capital, I think what you don't want is you don't want a board that is not very independent. You don't want a bunch of the CEO's golfing buddies on the board, because there's not going to be the checks and balances you're looking for. And I think the last thing in terms of the board is just his compensation. Usually they're compensated in 2 ways, and for the proxies I've seen, is there's kind of a flat fee, which can go anywhere from $20,000 for a small company to $300,000 or $400,000 for a big company. And it really runs the gamut in terms of that. And then they're also often compensated for being if you're on the audit committee, you get an extra X or Y. And so there's that, and then there's a long-term compensation where they get shares. And I just think that the only smell test I have is it just look egregious? Does this look like just the cushiest board position that all you have to do is show up 4 times a year and collect $200,000? Sounds like a great job, by the way, but I think you don't want to see something that is just out of line with what you think is reasonable. So yeah, I think those are 2 things. If as going back to just kind of overarching, compensation in general of the management team, and then board structure and compensation are two really important things we focus on.
Is there anything else in the proxy statement beside those 2 that really you think is sort of also important to consider in that evaluation of?
So maybe the third thing that we focus on, and there are a lot of things, and the proxies are often 100 pages, and there's a lot, but maybe, and not to get into every detail, but maybe the last thing, maybe not in order of importance, but kind of another thing that to think about is the change in control. So how is someone, and severance, let's take those 2 things. How is someone compensated if he or she is fired? And so this part of the proxy, which is buried usually at the very end, I think is really, really important and kind of telling about the company. And so let's just maybe go through an example, just a hypothetical example. Let's say that someone has a large change in control. So someone, whether it's share vesting and actual severance and pension and all those things that go into that final number. If there's a change in control and I lose my job, this is what I get. Let's say someone has a decent sized company, maybe it's $2 or $3 billion company. Let's say someone has a $40 million change in control. So there's 2 ways to think about that. The first way is that's egregious. This is not that big a company. That's a huge percentage of the value of the entire company. It's potentially going to dissuade someone from buying it because it's so large. There's this extra cost involved. And on the flip side is this management team is really, really incentivized to sell the company, right? And if you're a shareholder and you think that it's undervalued, that's a way of getting to fair value. And so there are 2 ways to think about that. I don't know the answer. I think just in general, if something is just egregious, based on the size of the company, based on the the responsibilities of the management team, it's just a red flag. I mean, yes, it might be good that they're going to sell the company, but it may mean that they're cheating and stealing from you in other ways, right? And so that's just something to think about. And the other thing to think about is what people get compensated for. And so there's a number of different things if you look at that last chart on the proxy. And so there's, firing with good reason, firing for no reason, firing, change of control without termination, change of control with termination, and there's just a bunch of different buckets there. And I can't believe that there are some people who get a large severance package if they get fired for good reason. That's insane to me. If you see that column should be blank as far as I'm concerned. That person should get a 0. If you did something unethical or that there was a real good reason for firing you, there's no reason for you to deserve something. And so that when I see a company that has that's that blank, that person gets 0, that's good to see. And then I guess The other buckets in terms of, whether they get fired, without good reason and how much they get, I think it's a smell test. Does this just seem out of whack for the size of the company, for the industry, those kind of things. And I do want to mention one more thing, because you couldn't mention the proxy statement without looking at the perks section. I would say corporate planes and unlimited use of the plane, and this is something my boss really hates, by the way, and I think I should mention this, is paying for an apartment in the city where the company is located, which means that the person doesn't live there. We are always really skeptical of management teams who actually do not live in the city where they work. I'm sure there are family issues and structural issues to it, but we really want someone on the ground. And so, if you see the CEO has an apartment funded by the company because he or she lives somewhere else, not a good sign. And so I think it's really interesting to read that perks section, and I think in general you should just, if it's longer than a few sentences, that should raise a red flag for you.
Help us understand, so we spent a lot of time on the incentives here, and really expressed through the proxy statement, whether it's for the management, the board, and there are all these other aspects that you talked about, but typically revolving around incentives. So when we step back and think about assessing management, which is the topic of our conversation, I guess what else is there then in terms of kind of getting to an investment decision? Help us understand how you take all that and then frame it in the larger context of assessing management, and then going from that to actually how that impacts your investment decision. Perhaps we could first tackle the first one, which is kind of, forming an overall view of management.
So there are a couple other things we do. I mean, that is what's available in the public forum, and so you can read all about how someone's compensated and how they're incented. I think the other thing that we do is when we always talk to management. I mean, just whether we meet them face to face or on the phone, depending on the size of the company, we always talk to management, and we focus a lot on behavioral questions. When you're talking to the CEO, especially, it's not the time to ask questions about what they're, what do they think is going to happen in CapEx next year or something like that. It's really behavioral questions. So we ask a lot of questions about capital allocation. What are your priorities? How do you decide when to buy back stock? What is your M&A strategy, and what multiples do you pay? Just a lot of behavioral things. And my favorite question for a new management team is, what did you expect going in there? What's different now? What would you change if you could change anything about this company? What people do you need to hire? So these are really kind of qualitative questions without any kind of, there's no numbers here. It's really just about, how is this person thinking about running the business? And so the goal is to figure out basically how they're going to allocate capital. I mean, if you have to just kind of narrow down, what do investors care about in terms of what management does? I think it's really about allocation of capital, whether that's acquisitions or buybacks or investing in the core business, or any dividends, anything else. I mean, I really think it's all about capital allocating. And so, at least from a first-person perspective, what are they saying? And so, in our decision process spreadsheet, which is kind of our last step when we're about to make an investment decision, we fill out a decision process. And one of the tabs on our spreadsheet is tracking management objectives. And so what we do is we lay out, anytime a management company says, we want to be at $2 billion in revenue and 10% margins by 2016, we record that. And any promises they make, we're going to have, we expect the synergies from this acquisition to be 200 million, or we expect to be able to cut run rate costs of 50 million in G&A next year. We record that, and so we have a spreadsheet that really tracks all that, and so that we can look back and see whether this person has delivered. The other thing my boss loves to do, and I should do more of, to be honest, is he goes back and reads, especially if someone's been there, a CEO's been there a long time, go back 10 years and read just the letter from the chairman or CEO. See what they were saying then. See if it's consistent based on the way they're measuring their own success their goals? Are there a bunch of different things that they laid out as opportunities that never came to fruition? Did someone say that we are not an acquisitive company and all of a sudden, they make 10 deals? Is that, just go back as far as you can and look to see what that person was saying years ago and see, businesses change, entities change, all things change, but it's also kind of a smell test to see if consistency. We're just trying to look for consistency, assuming we like what we're doing. If we don't like what we're doing, we want a change in consistency or a lack of consistency maybe. So there's that. So that's kind of comes from the actual management side. The other thing we do, and LinkedIn is an incredible tool. We look for people who used to work for the company, and we use LinkedIn to contact people and say, we just approach them and say, hey, we're investors in this company. We just wanted to talk to you about your experiences there. And it's amazing how many people talk to you. And so we talk to X this and X that, and usually we never try to contact people at the company because they're not going to talk to you, and we don't want people to talk to us. But one of the best, and you have to be careful here, because if someone was fired or they had a bad experience, they may skew it. But I just think one of the best ways to understand how a company works is to talk to the ex-employees. And the best endorsement you can ever have is, yeah, they fired me, but I haven't sold the share, because this is an incredible company. I mean, that's an endorsement, and you don't always get that. And you get a plethora of things. I mean, I can't even tell you the number of things people have said. And none of this is game changing, right? Unless someone says, I believe 100% in my core that this is a fraud, and I'll tell you exactly why. That's never happened. But this is it's just getting a smell, right? What do they say about the management team? What do they say about the culture? What do they say about their experience at the company? So that's another thing we do. The other thing we also do is almost always call the competitors. And I'm a little cognizant of being like, just calling up and be like, so what do you think of your competitors? You have to kind of massage it a little bit, but often some companies will say, we don't comment on our competitors, and others you just lead them into it, and they'll be like, they'll give you a sense of what they think and say, oh, how are you different here? How do you compete here? Or, what do you think of this management team? You've been here for a long time. To call the competitors, see what they have to say. If they're complimentary, they say they're a tough competitor. That's kind of what you want to hear. Or, if you hear, I could tell you a million stories about the extravagant spending of the CEO. That's just a little bit of a red flag. So I think using competitors, whether public or private, anyone you can talk to, I think is really interesting, and it just gives you a flavor. And so now to get to your question, how in the world do you distill all of this? So if you think about our goal is to compound our investors' capital, and the first rule is not to lose money. And the second rule, of course, is not to forget the first rule. And the point I'm making is that you want to err on the side of being really conservative. You never want to make excuses for people. You never want to say, yes, but. Yes, this person has a terrible reputation for overspending and making terrible acquisitions, but they've changed, or this or that. I think we run concentrated portfolios. We don't have the leeway. We don't have the, this isn't a tiny position that if it goes wrong, it's just rounding error. We take either 2.5% or 5% positions in our portfolio. And so we really need to, everything needs to be in place, right? For a 5% position, we want business and value and people to really, really line up. And a 2.5, you want 2 of the 3 to be really lined up, and the other one may be a question. But I think the one thing that is, if it's a question, we don't invest. It's the people. So if you like the business is good, the value is good, and the people so, I think that is a deal breaker versus the business is so, but the value and the people are good. So that's really the deal breaker. And so we kind of take everything and we record everything and we put it on a decision process. And I think the last kind of, the last test is whether we think we're at risk of losing money. And if we think that these people are really poor capital allocation, or they just don't think in terms of in the same way about the world that we do, I think that's a deal breaker. And I think we would tend to be more conservative about management than maybe any other thing. I think valuation, pick a number, tell me what happens in the future, I have no idea, right? That's kind of nebulous. The business, especially something with short track record, you don't know. But I think with management, if that's a question mark, I think that's much more likely to be an immediate no. And so there's nothing quantitative about this. Even if we wanted to score management on a 1 to 10, it would all be subjective. And so I think it comes with experience, and it comes with putting the mosaic together. You read the proxy, you talk to ex-employees, you talk to the management, and you're never going to know 100%. But I think as conservative value investors, you can get a sense of what these people are and what they do. And if you're not comfortable, and unless there are just some extenuating circumstances where potentially you think you can get them out, or someone's going to retire, I think we're more likely to pass.
And give us a sense in the investment process itself. Where do you perhaps stop spending the time on all of these steps that you've described here? So you like the business, you like the price, you start looking at the proxy, you start going through what you were describing. Give us a sense of where do you stop doing that? What is perhaps something you uncovered that has led you not to spend any more time on the company, on the candidate for investment? Or if you held it, what was the reason where management would lead you to actually exit the position entirely? If there is something like that.
I'm trying to think of an example of that. I mean, I think there have been certain times where, me personally, I've gone, there's actually an example. There was a bank I was looking at, and I'm not going to list the name. And I liked the valuation. I liked their footprint. I thought there was a potential for this to be a growth market. And all of a sudden, management did a secondary offering well below book value. A dilutive and no obvious need for capital. And that was it. That was just it. My boss said, no, I will never ever invest in someone who did this. And so I think that's rare, right? But I do think that we were there. Like, I was there in terms of and it was funny, it was kind of coincided with me being like about ready to pitch this to him, and all of a sudden they do this dilutive capital raise under book value. And it was just like, huh? This just didn't make any sense, and there was nothing that said this. The regulators forced them to do this. They must have just been kind of like, oh, we think we may need more capital in the future. The markets are open, but the impact of the dilution was obviously not taken into account, or maybe they didn't care, or maybe they weren't compensated properly. So that is one scenario where that was just an abrupt stop. My boss was just like, this is not a company that we would invest in. The people, as far as I'm concerned, the people are out. Right? Like, there's just, there's no opportunity there. I'll give you another example of something where we owned it, and it was finally the people just drove us over. I'm not going to name the company's name, but it was a company with an A-B structure, meaning that there were A shares and B shares, and the founder, well, I don't know if he was a founder, but the chairman owned the majority of the voting stock, and we had no say. And we had lived with it for a long time. And we woke up one day, and after indicating that he was going to hand over the reins to he'd been CEO. Let's take a step back, and had stepped back to chairman, and looking like he was about to hand over the reins to a new guy, abruptly pushed the guy out, and basically installed the guy from a guy he'd known who'd been on the board for a long time, and that was just it. We had no say. We'd lived with his poor capital allocation and poor decisions for a long time. That wasn't the first time that he had kind of given away the reins and then taken them right back, and that was just it. We really liked the value. We thought there was a huge potential to turn around the business, but he just wouldn't let go, and he always had to be meddling. And he was on conference calls, and just like, it was this bizarre thing where you had like 5 people on the call, one of them being the chairman and the CEO, and it's just like it just was way too much, and it was indicative of a person who wouldn't let go. And what it was really indicative of is someone who would not allow the company to change. And so, again, those are 2 real good examples of One where we lived with it for a long time and we dealt with it, and one where we got to the point where we liked the business and the value, and then the people kind of shut us out. So I think it happens a lot. And when we're looking at an investment, and we're making, we kind of go into our little conference room and we debate the company and both on business and value and people. It's rare that it's so egregious that it's that obvious, because that usually wouldn't get to that point. We wouldn't get to the final stage of the investment process if it was so egregious. But we really banter about that. And I think a question that I often ask is, do we know enough about this management team to make this bet? Right? Maybe sometimes you just have to watch them. They have projections, they have goals, they give guidance. Do they deliver? Right? And the good thing about our business is that there are no cold strikes. If we pass and the stock goes from 20 to 40, yeah, it hurts, but that's life, right? And our clients would never know the difference, and you never know whether it would have been just luck or whether it's skill. And so we don't want to be in a position where we're taking chances on people that we don't understand. And so aside from doing all the diligence up front, if it's a new industry especially and a new management team, we may wait a little while and just watch them. And luckily for us, markets go up and down, and sometimes you get another shot.
Ben, is there anything we haven't discussed that you think is really important to this topic of assessing incentives, assessing management overall, assessing the leadership, I should say, at a company, including the board? And we cannot certainly do it justice in the time that we have, but perhaps any last word of advice or just practical things that you would recommend investors focus on in their day-to-day to become more aware of some of these issues and the importance of them?
Yeah, well, I'll start with one, and then if I can think of anything else, I'll mention it. But I think a question you have to ask yourself, and as you're looking at companies, does this management team have the right people in place in terms of positions? And so I'll just talk a little bit about the chief operating officer position. If you read The Outsiders, the Thorndike book, which profiles a number of really good investors, one of the common themes in that book is that a lot of these great capital allocators had a chief operating officer. And so it's an interesting kind of tell about the skill sets needed to be good at, to be a good chief executive officer, for example. I mean, if I had to characterize what I want the CEO to be good at, I think it's capital allocation. And certain people, and I think Buffett would be a great example of this, someone who's incredible at capital allocations and will honestly say that he doesn't know a damn thing about running a chocolates business or running a railroad, right? And so Buffett basically has, chief operating officers. I mean, they're not necessarily called that, but they're operating people at each level, right? And so he doesn't, he's not meddling in what Burlington's doing. He's letting the people there figure that out. And so I think, I think that's a positive. I think if you see a CEO who understands that he or she needs to be in a position where he or she can think about the kind of broader things like capital allocation and long-term company strategy, and leaves the operating kind of responsibilities to a COO, I think that's a positive. I'm not for creating layers of management. Of course, that's not the answer for it. But the answer is to kind of make sure, just like the chairman and CEO. The reason we like that to be split, I think I like the idea of a CEO and chief operating officer split. And so that's just a little tidbit. And there's a million different variations of whether that's correct or not. But I think that's if you read the Outsiders book, I think that's an interesting little tell about how a company's run.
On that note, Ben, thank you very much for your time.
Thank you. And
giving us a glimpse into the day-to-day of what it takes to really focus on the right things, such as the proxy statement when it comes to assessing management.
Well, I appreciate it. Thank you. And I hope this has been helpful for people.
Absolutely. Thank you very much again.